Hello. In this video, we'll continue with the Section 162 General Business Deduction and will specifically consider the fourth and fifth requirement, the paid or incurred during the taxable year requirement, as well as the in carrying on. Now recall that for a business taxpayer or any taxpayer, individual taxpayer that's conducting trade or business, for the taxpayer to be able to deduct an allowed deduction as a general business deduction under Section 162, the taxpayer must meet 7 criteria. The outflow must be ordinary, necessary, and expense paid or incurred during the taxable year in carrying on any trade or business, and it must have adequate substantiation. Again, we'll be considering number 4 and number 5. So the fourth criteria is that the outflow must be paid or incurred during the taxable year. So before we consider whether it's an expense, so you go in order. So at this point, we've already considered whether it's an expense versus capital expenditure. So is the expense paid or incurred during the taxable year of the taxpayer? Now this really gets at the cash method. The methods of accounting. The cash method is going to be discussed. The methods of accounting involved of the taxpayer. So the methods of accounting. And there's really 2 methods of accounting with respect to taxpayers out there. There's the cash method and there's the accrual method. And you can also be a hybrid. We're just going to talk about the cash and the accrual. Now the cash method is the first type, and the cash method, a cash method taxpayer generally can claim, so we're talking about just claiming deductions. With respect to income, that was in a previous discussion with regard to the inflow of income. A cash method taxpayer generally may claim a deduction in the taxable year in which the deduction is paid. That's the general rule. So the general rule is when it's paid. The accrual method taxpayer, the general rule is when it's incurred or owed, not necessarily when it's actually been paid. So I want to talk about some specific items with respect to the cash and the accrual method. Some specific issues. So first, let's start by talking about the cash method. So with the cash method, the issue becomes, when is actual payment? So when is actual payment? When does that actually occur? Because you might have a check or you might be paying with a credit card. So actual payment can occur by cash payment, by transfer of property, so even property, not even cash, or by the performance of services. All 3 of those can result in actual payment. Payment by check is considered to occur when the check is delivered, as long as the check is honored when presented for payment. Now, payment by credit card is deemed to occur at the point of sale, not when the taxpayer is billed or when the bill is paid. So that really is when actual payment occurs. Now, if actual payment has not yet occurred, there is no deduction yet. It can, when the payment does occur, that's the year of the actual deduction. So it's not saying that, okay, you don't get Section 162 ever. If you meet the other criteria, the other 7 criteria, and it's just an issue of the timing, right? This is all about timing. The method of accounting, this item is all about timing. When is the deduction going to happen? It's the other criteria can determine whether it does or does not happen. This one is more of a timing issue. So if there's no if there's no actual payment in your cash method, then you can't take it this year, but you might be able to take it in the future. Now, another issue to discuss, advance payments. So what happens if, let's say that you are a business and you are renting or leasing a building and some land, and you decide to prepay the rent. Can you take a deduction early? Well, generally speaking, if the taxpayer is paying not more than 12 months ahead, so no more than 12 months, so let's say less than or equal to 12 months ahead, then it can be deducted. It can be deducted. But if it's greater than 12 months, it cannot be. So if it's greater than 12 months, you have to wait for the deduction. But if it's less than or equal to 12 months ahead from the time paying with respect to the advance payments, then you can deduct in the current year, in the year of payment. So that's really all there is with regard to the cash method. Let's talk about the accrual method. Let's put 2 lines here to denote that we're going to talk about the accrual method down here. So under the accrual method, we record deductions when they're incurred or owed, not necessarily when payment has been made. So incurred or owed. So we have to go through when exactly does the incurred or owed, when does that happen? So we'll just say incurred. When exactly does that happen? So first thing we have to look at is we have to look at all events, the all events test. So the all events test, have all events occurred that establish the taxpayer's liability to the deduction item? If so, we continue because we're going to have other things to consider. If not, then you can't yet claim it. You can't yet claim the deduction. So contested liabilities are an example where there's not a full liability with respect to the item in terms of it's actually happened. So if it's a contested liability, then it hasn't yet met the all events test. The next thing is reasonable accuracy. Reasonable accuracy. And reasonable accuracy deals with, can the amount be determined with reasonable accuracy? If it can't, then you're going to have to wait until it can. Next is economic performance. So economic performance is really the key because, again, with the accrual method test, we're looking at when performance has occurred, whether it's a service, the service has occurred, or if it's a good, when the goods have been transferred. And that's really what I wanted to highlight there with respect to the accrual method. And there's other various issues regarding workers' compensation and tort liabilities and recurring items exceptions. I don't want to go into those specific items, but just keep in mind that with economic performance, for goods, it's when the item generally has been delivered to the, or it's been sent off, FOB shipping point, FOB destination. It's when title is transferred, right? Title is the key. Title has been transferred. And for services, it's when services have been performed with respect to the contract with regard to that actual payment, and whether you now have to pay for those services. So it's all about performance for services. So that really ends a discussion with regard to the paid or incurred, the method of accounting issue. So the 5th requirement in the 7 requirements for deductibility under Section 170 or 162 deals with in carrying on. Is the taxpayer already carrying on the activity when the business expense is paid or incurred? So what this is trying to distinguish is when a taxpayer already is in the business, already in the business line, versus taxpayers who are seeking out getting into a business line and the expenses related to that. That's really what this is distinguishing. The Supreme Court has interpreted the in carrying on to be in the course of or in connection with an existing activity. So again, the key is that it's existing activity. And it has to be an existing trade or business. I said existing activity, existing trade or business. So when we look at the trade or business requirement later on, it has to be an existing trade or business. Just keep that in mind. Again, it's distinguishing the searching for activities or seeking out activities. Now, there was a tax court case called Morton Frank in 1953 that the taxpayer was employed by a large newspaper in the Midwest. He decided to try and buy a newspaper in a small town, and he made numerous trips to various towns in order to evaluate newspapers that were for sale. As of the end of this tax year, he had not yet found an acceptable paper to buy. He deducted all of his traveling and other expenses relating to his investigation activities. Now, the tax court, and again, this case is called Morton Frank, and you're welcome to look into this case in more detail because it's a very interesting case. The tax court said that because the taxpayer was an employee of the newspaper business and did not own the newspaper business, the taxpayer, even though was looking to get into the newspaper business and buy his own newspaper business and be an owner, he was actually viewed to not be in the business of being an owner with respect to business. I know some of you out there are thinking like, well, that's crazy. Like, you're an employee, doing the same thing, but then you're an owner and you're going to probably be doing the same thing, because I'm assuming that when Morton Frank was looking at going into the newspaper business as an owner, he was probably going to be the only employee, at least starting out, because he was looking to purchase a small newspaper company. So again, the key is that he was an employee in an existing line, an existing newspaper company, and he was interested in owning. And again, he never owned a newspaper before. He never owned a newspaper, and because he never owned it, the tax court ruled that this is not considered in carrying on. The expenses in seeking out, and doing the research and whatnot, and traveling to, learn more about this newspaper he was interested in purchasing, they were held to be disallowed because they were not in carrying on. Now, some other areas that, you're probably thinking out there, okay, well, what are some other examples of where it's not considered in carrying on? There's actually lines of cases dealing with hotels. And a hotel line, or a hotel motel, I say hotel, but it could be motel, where, let's say that you own a hotel or motel, and let's say it's on I-75 in, I don't know, the middle of nowhere, just outside of Valdosta, Georgia. And you have owned that hotel for a long time, and it's right off of I-75, right off the exit, and that motel, the purpose of that motel is just for travelers to stop for the night and then wake up early in the morning and continue on the ride, maybe down to Miami, or maybe they're going up to Chicago from Florida or whatnot, or up, up to Midwest. And, the idea is that it's a stopping point. And let's say that you've been, or a taxpayer has owned a motel on I-75 in Valdosta, Georgia, and been doing this same, again, that motel has been meant for those travelers, so it's a travel stay where people just stay the night. And you're interested in maybe retiring on the east coast of Florida, let's say Daytona Beach, Florida, and you are interested in purchasing a motel, very similar size, maybe the same amount of money. I know it sounds crazy, right? Same amount of money, but same size, and you're interested in selling yours, and you're looking at motels in Daytona Beach that, and you're saying, okay, well, it's a motel, and I'm already in that line of business. Well, there's actually case law out there that says that, well, because Daytona Beach on the beach is more a destination where people go to stay multiple days, and it's not traveling overnight, it's viewed as a different line, a different business. It's not in carrying on the same tier of business. So the hotel motel, they contrast, overnight hotels where you just stay the night just for travel, right? Travel hotels with destination hotels. So that's another example of where you can see some distinguishing idea here. So that Morton Frank, and there's also the hotel line that helps you understand that idea. Now, you can't necessarily you can't deduct it under Section 162, but there is a provision, Section 195, deals with startup expenditures. And Section 195 is when Section 162 does not apply. So if you do not get Section 162, so if Section 162 does not apply because the carrying on requirement fails. So if you fail the carrying on requirement, you can go to Section 195, which can allow you to capitalize and possibly deduct some of your searching costs before you're in that actual line. Now, the key is that you actually have to go through. You have to start. So those expenses, right, in seeking out That's what we're dealing with. The seeking out expenses. Those startup expenses like, doing research, traveling to, learning more about the company that you're interested in, purchasing, or just the industry that you're looking at. You can actually deduct those if you start it. If you don't start, you can't deduct. It's just, you don't get to deduct it, unfortunately. But if you do start the business, you can capitalize. So the general rule is that you capitalize and deduct over 15 years. Over 15 years. Now there is one exception to the general rule, and that is for small businesses. And this number has changed over the years. It was 5,000, and then it was 10,000. So this, I'm just going to say for small businesses, I'm just going to write this down. You're going to need to look at your specific notes with regard to this because it changes. It changes many, all the time. It was so when I first learned about tax, it was $5,000, but once you exceeded 50,000, it was dollar for dollar reduced. So let's say you had $52,000 in startup expenses, you could only do you could do 5,000 total, immediately. But once you got over 50,000, it was dollar for dollar reduced. So if you had 52,000, you would actually take the 2,000 that exceed the 50, and you would subtract that from the 5. So you can only do $3,000. And then the other of the 52,000 of startup expenditures, of the other 49,000, because 52 minus the 3 you can take currently, the other 49,000 will be capitalized and amortized over 15 years. Amortized over 15 years. So that's really key. That 15-year rule has been in play, but small businesses can elect to take a portion. Again, it changes based on the year, so make sure you look at that. Can elect an amount for the current year. And that's really all there is with respect to incurring on. So again, the incurring on limitation, it limits to already existing businesses, but if you are not already an existing business, Section 195 might provide some relief. But again, the general rule is to capitalize and amortize over 15 years, which is 180 months, and does not allow for you to immediately expense like it would under Section 162. Now, if you are already in an existing business line and you're doing these items, then you can deduct it immediately. And that really concludes the fourth and fifth requirements of Section 162.